Hey friends, welcome back to the channel. Today, we're going to answer one very simple question. This is what happens when you reinvest your dividends for 20 years. I'm going to show you real data, real stocks, real numbers, and you'll see the power of compounding play out right in front of you. This is going to blow your mind. And I'm also gonna share exactly how you can do this yourself in less than 60 seconds. Let's get right into it. I want to start with a quote from legendary investor Warren Buffett. He said, "The first rule of compounding is to make more money than you have. The second rule is to do nothing." And I think that sums up the importance of reinvesting. It doesn't take much effort, but the results are explosive. So let's start with some basic math. What if you put $10,000 into Coke stock 20 years ago? We were talking January 1999. You'd be getting about 2.5 shares for every $100. So 10,000 would give you about 250 total shares. And here's the dividend history of Coke, dating back 20 years. If you took these dividends as cash, you'd have about $54,000 today. But what if instead of taking that money, you reinvested it back into more shares of Coke? Well, that would mean you'd actually have 537 shares. You'd be buying an extra 3/4 of a share for every $100. In fact, at the end of the 20-year period, you'd own $95,634 worth of Coke stock. That's almost double the return just from one single setting. Now, that's the power of compounding. Some people might say, but wait a minute, that's only a 3.5% dividend yield. And you're right. But what they don't realize is that yield is only one piece of the equation. Yes, if a stock pays a 10% dividend yield, you'll get more money in the short term. But if you want the best long-term results, you need a stock that does two things. One, pays a decent dividend yield. And two, has the ability to grow that dividend over time. And that's exactly what's happened with Coke. Their dividend has grown for 61 consecutive years. That's the longest streak in the S&P 500. By reinvesting your dividends, you're able to buy more shares of that company, which gives you more exposure to their growth and allows you to capture more upside. That's what happened with Coke. That's what happened with Apple. That's what happened with Johnson & Johnson. Speaking of Apple, let's take another look. Imagine you bought $10,000 worth of Apple stock 20 years ago. Back then, they were paying about a 1.5% dividend yield. That's not very high, but here's the thing. They have a lot of cash flow. They can afford to raise that dividend. If you took the dividends as cash, you'd have around $15,000 today. But if you reinvested those dividends, you'd have a little over $20,000. That's the magic of compound growth. Apple stock price goes up, the dividend increases, and then you're able to buy more shares. What about an ETF like VU, the S&P 500 ETF? We all know the S&P 500 has had incredible returns over time. But what most people don't know is that dividends are responsible for the majority of those gains. Without reinvesting dividends, you'd have about $65,000. But with reinvesting, you'd have over $105,000. That's a huge difference. So now you're probably wondering how this works. How does compounding work? Well, there are two pieces to the puzzle. First is compound interest. We've all heard of this. If you put $10,000 into a savings account at 5% interest, you'd have $10,500 after 1 year. Just take a look at this money tree. The longer you leave it alone, the more it grows. You plant a seed, you water it, and the tree bears fruit. Each fruit then produces more seeds, and before you know it, you have a forest. That's the power of compounding. Albert Einstein once said, "Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it." That's why millions of people pay off their credit card debt with such high interest rates. But that same principle applies to your investments. Compounding is a force multiplier. It amplifies your gains and turns them into something life-changing. So now I'm sure you're wondering, how do I actually do this? Well, it's incredibly easy. All you have to do is log into your brokerage account, click on the individual stock or ETF, and then under Trade. You should see something that says Dividend Options. Click on that, and then you LLC, an option that says Dividend Reinvestment Plan or DRIP. Simply check that box, confirm it, and that's it. From that day forward, your dividends will be automatically reinvested. Now, I want to point out some brokerages may charge a fee for this service. For example, Fidelity charges $1 per trade. So if your dividend payments are less than $1, it might not make sense to do this. But for big companies like Apple or Johnson & Johnson, you'll be good to go. Other brokerages like Vanguard and Charles Schwab do not charge any fees. And if you're an active trader, platforms like Robinhood or M1 Finance allow you to easily reinvest as well. Here's a quick summary of the main takeaways. Number 1, it's incredibly easy to do. Literally takes one click. Number 2, it's only available in certain countries. Right now, U.S. investors can take advantage of this tax benefit. However, there are other countries looking to introduce similar programs. And no. 3, you must have patience. Don't take your dividends as cash because you need the money right now. If you're truly playing the long game, you need to be patient. Allow your investments to compound. All right, let me give you a quick update on my own portfolio. I started investing in 2015, so I haven't quite reached the 20-year mark. But one of my best performing ETFs is SCHD. It has a 3% dividend yield and has increased their dividend for 7 straight years. If you look at the graph, you can see that the blue line is significantly higher than the red line. That's the difference between reinvesting and not reinvesting. As of recording, I own 27 shares of SCHD, which brings in about $11.70 every quarter. That's about $47.40 per year. And I've been reinvesting all of that back into more shares of SCHD. And lastly, I want to share a simple dividend tracker that you can download for yourself. You can track your holdings, track your dividends, reinvestment amounts, new shares purchased, and you can see your total compounding growth. It's very clean. I created it in Google Sheets, but you can also use Notion. Either way, it's completely free. So check the link in the description. And that's it for today. Thanks so much for watching. Don't forget to hit subscribe, and I'll see you in the next video.